these last few days. It was totally unnecessary. I'm still trying to get my head around what the cause and effect was, because the cause went away after 3 days, and we're kind of back to the level where everybody was kind of freaking out, but they're not freaking out now about where.
Oh, I think, look, I mean, you've probably heard about 100 different causes in the last couple of days, and you've probably bored yourself and your audience to bits. But I mean, what happened was that people got frightened of a wage increase, which is a very maverick number, and it doesn't really cut ice. This made them frightened of interest rates going up faster, and of bond yields going up more. And of course, at some point, if inflation is squeezing profits and increasing interest rates, your corporate profits don't look so good when you're buying equities, because the profits could be lower, squeezed by wage inflation, and inflation could be higher and bond yields could be higher. So people said, oh dear, oh dear.
Oh dear, oh dear.
And so you actually rediscovered what you and I knew when we were young people, which was that actually when bond markets go down and yields go up, normally equity prices fall. Instead of bond prices and equity prices moving together always in the same way, the negative correlation is rediscovered. Now, I think what you've seen is a correction. You don't have really the macro reasons for this market to collapse, and I'm sorry if I sound like a broker trying to tell you to go and fill your boots, but I'm not. I'm saying I think there are major, major problems down the road, but this is not it. So you might get another little sell-off, and then it'll start to go up again, reach new highs, and then will come the real problems.
Yeah. The first 4 weeks of 2018, you saw the headlines, you saw the media going, melt up, melt up, melt up. Never before in the history of man have we seen such concerted growth around the world. Look at this. I mean, the world is all on the same page. We have unanimity across the world, and plump, like that. It's like, it would have been nicer if it was a little more metered, a little more measured on the way up, instead of saving it all and saving it for a long weekend.
Well, look, Bernie, what the chorus line was saying, as they kicked higher every time, was we're in a wonderful world where interest rates won't go up, and the growth will go up, and therefore profits will go up, and ho, ho, ho. But of course, if everybody is growing, then sooner or later you're going to have some form of inflationary pressure. I think it'll be much lower than in previous cycles. But look, let's cut to the quick. I think the 10-year bond in the U.S. will be at least at 350 to 360 before the end of this year, and the 30-year will be pushing 4%. Now, I think it is most unlikely. That is actually based on central bank to Fed tightening. It is based on the fact that the interest rate cycle is advanced and the economic cycle is advanced, and you will get some inflation. There's no doubt about it. Not huge inflation, but you will get some inflation. And the question then is whether the equity markets will be happy with those levels of bond yields, and I would suspect not. So I think there is, this was in a sense a trailer to the main feature, but it's not the main feature. It's down the road when the reality of higher interest rates and the maturing of the U.S. economic cycle become fixed in people's minds, but it ain't